Welcome to PhillipCapital Experts Talk. My name is Lindsay from Phillip Securities Research. Today, we are privileged to have Mr. Devan Kaloo, Head of Emerging Market Equities from Aberdeen Asset Management, to share with us some of his insights on emerging markets and how he positioned his portfolio amidst current economic uncertainties. Devan is Head of Global Emerging Markets, responsible for the London-based Global Emerging Markets Equity Team, which manages Latin America and EMEA equities, and also has oversight of Global Emerging Markets Equity Team input from the Asia team based in Singapore, with whom he works closely. Devan joined Aberdeen in 2000 on the Asian portfolio team before becoming responsible for the Asian ex-Japan region, as well as regional portfolios within emerging market mandates and technology stocks. Previously, Devan worked for Martin Currie on the North American desk before transferring to the Global Asset Allocation team and then Asian portfolios. Devan graduated with a MA Honours in Management and International Relations from the University of St. Andrews and a postgraduate diploma in Investment Analysis from the University of Stirling. Thank you, Devan, for taking time to attend this interview with us. 2014 has been a disappointing year for emerging markets. Developed markets have been outperforming emerging markets as emerging markets continue to face challenges at the outset of 2015. Low commodity prices, weak currencies, and tepid growth are some of the factors working against the economy. Investors shift their focus back to developed markets, and we are seeing continued fund outflows from the emerging markets. Could you share with us a brief outlook on the emerging markets, and what do you think will surprise us in 2015?
Well, thank you very much, first of all. I think one of the interesting things to remember about last year was that actually emerging markets were the second best performing asset class. So when people talk about emerging markets underperforming developed markets, actually emerging markets underperformed the US. They outperformed Europe, outperformed Japan, outperformed the UK. And the reason why I talk about this or raise this as an issue is because last year it was all about the dollar and the strength of the US stock market. And in 2015 there are very similar concerns. And our view is that actually potentially this year those concerns are overdone. We see certainly for emerging markets an opportunity, and the opportunities come in three ways. First of all, one of the things that you see is that most emerging markets are beneficiaries of the fall in the oil price. And that should lead to lower inflation and indeed potentially stronger growth. And that's probably going to be the first positive in emerging markets that you've seen for many years now, for 3-4 years. The second thing is that you're probably going to see China trying to re-stimulate its economy, which will be a benefit for the rest of emerging markets. And thirdly, for many emerging markets, you will see profitability at corporates improving as they have bottomed, and we should see some sort of improvement this year going into next year. So actually, we are fairly positive about the outlook for emerging markets. Certainly relative to lots of other asset classes like Europe, like Japan, we think emerging markets stand out as offering good value and potentially good opportunities as well.
What do you see as the most important emerging markets? In your view, what are the major drivers and trends in these emerging markets?
Well, I think the things that have done really well so far this year have been the markets which are the biggest beneficiaries of the fall in the oil price. And certainly there's a lot to be looked at there. So places like India, Indonesia, lots of Southeast Asia were beneficiaries of the falling oil price. But there are, outside of that, quite a few interesting places as well where valuations look very attractive, and if you're a little brave, perhaps you want to look at as well. And we would suggest that perhaps you want to look at Brazil, you want to look at potentially Turkey, and indeed, if you were very brave, maybe even Russia, because the valuations in some of these markets are pretty compelling. And if you've got a 5-year view, we think it doesn't look too bad.
How can investors capitalize on these opportunities?
I think one of the things that people forget about when they think about emerging markets is that these are relatively illiquid asset classes, certainly in relation to the developed markets. And people think of this illiquid asset class as being a dangerous asset class because you see quite great volatility in the share prices. And we would point out that actually that's not necessarily the case. Because there's a mistake. The mistake that people make is that volatility of share prices equals weak economic fundamentals or weak corporate fundamentals. And that's not true. In many emerging markets, we find that the economic fundamentals are fine and getting better. And indeed, corporate profitability is fine and getting better. So when you look at emerging markets, I think you need to be conscious that there is volatility in the short term, but in the long term there are very strong fundamentals underpinning the asset class. So we would say that if you've got to invest in emerging markets or you're looking to invest in emerging markets, you should be wary of volatility, but be confident in the longer term, because ultimately these are the most interesting asset classes to invest in.
4 major topics were under discussion in the EMs right now. Slowing growth for one, interest rate and inflation rate, oil and commodities prices, and politics. What is your view on these topics?
Well, I think the big issue obviously is the oil price. And with the oil price, as I said, you've had the benefit of lower inflation and potentially a stimulus for growth. If you look at some of the other issues, some are good, some are bad. It's a mixed picture. But I think one of the key things that you're seeing in emerging markets is that politics is actually improving. And one of the reasons why we would say that is that if you look across the board, whether you're talking about Asia or indeed Latin America and even the Eastern Europe, politics, governments are having to change, they're having to reform. And one of the reasons why they're having to reform is because they need to attract foreign capital, because the foreign capital is needed to fund their growth. And as a result of that, you're actually seeing some interesting things happening, which I think are very positive. So we are positive on the political developments. I think largely there's some very interesting things going on and they should benefit the stock markets. Why didn't that? You mentioned economic growth. Yeah, economic growth is slowing, but actually economic growth for most emerging market countries has been slowing for 3 years. I think we are probably at an inflection point this year. Most emerging market economies will have a better 2016, and maybe you want to position yourself today for that.
Referring to your earlier point on Brazil being one of the emerging markets which you see opportunities in, post-election and against the backdrop of high inflation rate and high interest rate, how should investors position themselves?
Well, I think when you look at Brazil, there's an awful lot of bad news. So you had an election last year whereby the incumbent got won re-election and the market took that badly. You have a major corruption scandal with regard to Petrobras, which is affecting actually some Singaporean companies as well because they're suppliers into that. And you have, as you say, high inflation as the currency has weakened as a result of the various problems they have economically. And we would say you need to look a bit beyond that. Because if you look at what actually is happening on the ground, first of all, because of the problems domestically, the government has had to introduce a new economic team. And the economic team is focused on trying to deal with some of these underlying issues, and we think have great credibility. And they have to change because there's no alternative. If you look at things like Petrobras and the corruption scandal there, well, actually that's good for the long term, in that if it cleans up government, if it improves corporate governance and economic structures in Brazil, that's good for the country and indeed potentially for investors. And with regard to inflation, they're tackling that. They've raised interest rates, and we think by the end of this year inflation will roll over and start to come down, interest rates will start to come down, and as a result you will see a benefit for both fixed income investors as well as equity investors. So again, you need to think slightly longer term than what is just what's happening in front of you. And if you do that, then I think actually Brazil is quite an interesting place to invest.
As you have pointed out earlier, most of the emerging markets assets are illiquid. How do you manage foreign exchange and liquidity risks?
Well, most people will tell you that you need to take a view on foreign currency. So you need to take a view on what you think is going to happen to the Indonesian rupiah or the Turkish lira or whatever. We would say actually in our history, and we've been investing, or I've been investing in emerging markets since 1994, I would tell you that trying to predict what currencies are going to do is very, very difficult. There are lots of different variables that go into it, from government policy to what's happening globally to what's happening with liquidity flows. So the key way to manage FX risk or foreign exchange risk is to make sure that the companies that you invest in don't have major mismatches. So what I mean by that is that if you have a company that borrows in dollars and makes its revenue in, say, Thai baht, there's a mismatch. So when the baht devalues, suddenly you've got a major problem. Those are not the sort of companies you want to invest in. So the key way to manage FX risk, in our opinion, is to make sure that you have management who are sensible, who manage the balance sheet in a prudent way, and they don't take unnecessary risks. And in that regard, there are lots of very experienced management in emerging markets who've been through this before, who manage their business in a prudent and conservative way. And as a result, I would say actually, not that you want to ignore FX risk, but you should trust in management to manage these issues. And in that regard, that's probably the best way to go about doing things. The last point I'd make is actually, in many cases, to hedge the currency risk is expensive. So if you don't have to do that, and you can pick the right companies, it's a much more profitable way to invest.
Are there any other advice to our emerging market investors?
I think when we talk to investors in Asia, they're familiar with the issues of emerging markets because they live in and around emerging markets. And ultimately, they know that emerging markets are some of the most dynamic places in the world, that there are some fabulous companies in emerging markets, and that longer term, this has to be the areas you want to be in because the opportunities are tremendous.
Once again, thank you, Devan, for sharing your insights with us here today. For more information on unit trust, please log on to www.poems.com.sg/unittrust or talk to us at any Phillip Securities branches. Thank you.